Welcome back. I know I'm about a week late on this one, but I wanted to talk about HP because Warren Buffett, or I should say Berkshire Hathaway, just purchased a massive stake in HP stock. What we're going to do in this video is take a deep dive into the financial statements, the income statement, balance sheet, cash flow statement, and then come up with our own valuation as well as, try to put some kind of metric on the qualitative side of the business. All right, so let's go over this article real fast just to show you some of the points from Warren Buffett's purchase. They bought 11% of the company, worth about $4.2 billion. And this is HP, the PC and printer maker, right? This is the one thing down here that I wanted people to take note of here it is. HP has a steady track record of returning value to shareholders through share repurchases and dividends. Since its split from HP Enterprise Company in November 2015, the company has returned more than $21 billion to shareholders through share buybacks and dividend payouts. All right, so $21 billion compared to a market cap of $40 billion. I got the market cap up in the top right of the screen there. That's a significant amount, okay? So that's interesting. I'm excited to see that in the financial statements. All right, so let's get started. I'm just going to show you an overview real quick and we'll look at the stock. So you can see what we have here. I got all the kind of ratios on the left, the PE, PB, PS, price of sales, and then the 1-year high, 1-year low, and volume. And I just want to show you on the stock. I mean, he announced that he had bought it, I guess, on, what was that, April 6th or 7th, so right here. Yeah, and then it jumped immediately, that 14%. All right, so the question we're going to try to answer here is this still undervalued, and should we be buying it right now? The first thing I want to look at is the income statement, and the first thing on the income statement we're going to look at is total revenue. All right, so let me say something about this stock, because this was actually featured on one of my group valuation videos where I look at, I think, like 6 stocks in a row and just do quick screens on them, and I actually didn't like it through the screening. But one thing I noticed is that I was looking at this huge time scale on my graph, and let me show you like real quick. If I pull this way up, I was looking all the way back every quarterly report to 2006. So my scale was kind of skewed because I'm thinking, man, what happened? The revenue dropped off and all that. But it was due to that thing that the article mentioned since 2015, whenever they split from the other company. So that's why from now on in this video, we're just going to look at 2016 on. So here we are from 2016 on, and you can see the revenue is growing, which is what I say we always want to look at. We want to make sure revenue is growing. It's growing. I mean, that's awesome. Okay, let's see what's next. Gross margin. Gross margin is a great way to judge a company's competitive advantage. Y'all know it by now. I would say this is a pretty low gross margin, but at least it's consistent. I don't think they get any points for this, but it's not terrible. All right, let's go to R&D. All right, so R&D, I mean research and development. And what I like to look at here, and it's something that I know Warren Buffett, or at least books that talk about his way of investing has talked about. You look at research and development as a percentage of gross profits. So of their gross profit, how much is having to be spent in innovating, staying on the cutting edge of technology, keeping, competitors at bay, that type of thing. And what you're looking for here is low is great. What you really want to be cautious of is finding a company where a huge percentage of their gross profit, like 25, 30+%, is going to research and development, because that shows you that, they're kind of relying heavily on R&D to keep up that revenue growth. And it's hard to innovate. That's what research and development's doing, right? It's innovating, it's developing new products, researching new, technologies, and that's hard to continue. So that's why we like to see it low. It's kind of like the gross margin. It's not terrible, but it's kind of in the okay zone, this 12 to 14%. The good news is it's decreasing lately, so that might be a sign that, it could be bad though too if you think about it. It could be that they're reducing research and development, and that might be inflating their profits in the short term, but in the long term they're actually going to be sacrificing innovation and growth. That's where your competency of the company comes in. That's where a better understanding of management and the direction of the company will tell you that type of thing. So it really can mean both. I'm not going to mark it green or red for the sake of the outline over there on the left. All right, let's go on to their interest payments. So this one's going to be interesting. This is their interest payments as a percentage of their operating income. Let me do this. I want to change that scaling real fast. How do I do that? Yeah, let me just delete that one. Okay, so if I look at their interest as a percentage of operating income, you can see super low, 5%, less than 5% recently. That's a great sign. Again, what you hate to see is a company that's making a lot of operating income, or a company that's spending a lot of their operating income just paying interest payments, because interest payments are just thrown away. That's, it's like another tax on your company. So having that low is great. All right, so I like to see that. That's definitely getting a green. let's go to our pre-tax income. The first thing that comes to mind here, obviously, for everybody, I would think, is this huge spike, all right? So look at this. You're pretty consistent. You made a little bit of a step change, hovering around $1.5 billion a quarter in pre-tax income, and then boom, you spike all the way to 3.5. I'd be curious to see what that was from. Obviously, we like seeing that as opposed to having an outlier down, but at the same time, I'm not going to count it in this calculation, okay? I think that could lead to an overvaluation. So what I'm going to do instead is just take the average of these four right here and ignore this outlier, okay, to get my, I guess, prediction of the pre-tax income. So I'm just going to average this one and these three, and I guess sum them, not average them. And the sum of those four quarters is $5.3 billion. So I'm going to write that over here in the outline, $5.3 billion. We're going to use that later in the valuation section of the video. All right, and now a growth rate. So a growth rate, you can see I'm going all the way back to only 2016 that this graph goes to, because like I said, that's whenever they had that shift in the company. So you don't really want to take anything before that. So what I'm going to do here is say from 2016 to now, so 6 years, they went from $1 billion a quarter to, what was it, 5.3 divided by 4 is 1.3. So they went from $1 billion a quarter to 1.3 in 6 years. So to get that annualized as a growth rate, you do 1.3 divided by 1, and you raise that to the 1 over 6 because it's 6 years. And you get an annualized rate of, well, you subtract 1, 2, and you get 0.0446, so 4.47%. I'm going to round down and say 4%, all right? So 4% growth moving forward is what we're estimating. Let's go to our earnings per share. This is the last thing for the income statement, and it's going to be quick because this is just another one we get a valuation metric from. Again, I'm going to ignore this one. I'm going to do the same exact thing, just sum these last four, ignoring this one. Okay, so if I do that, let me get the decimals back in here. All right, if I do that, sum of this one plus these three, and I get $3.72. That seems low. Let's see. 372. All right. The reason I said that seems low is because your pre-tax income, I had $5.3 billion. So if I divide that by the number of shares, which is 1.06, I get $5 a share. And so $5 a share pre-tax and $3.72 after tax. That's a pretty big tax rate. Let me see. 372 divided by 5. Minus 1, so 26% tax rate. Corporate tax rate's 21%, so now I'm curious what's going on there. Let's see. If I go to tax, let's see, tax provision. I mean, I see this outlier, but we didn't even count that quarter, so it's just confusing. It's not crazy. 25.6% is not that much different than 21%, but it caught my eye. That's all I'm saying. All right, let's go to the balance sheet. The first thing we're going to look at in the balance sheet is the total tangible assets. You've seen my quotes before in my other videos. I've talked about it. Warren Buffett said his definition of a good business is a business that earns a good return on total tangible assets. And then he goes on to say a great business is one that earns a good return on tangible assets while the tangible assets are growing. All right, so the tangible assets here are growing. So let's see what their return on those assets is, and that's going to tell us a lot. Let's see, where is it? Pre-tax return on tangible assets. Okay, so what this is saying is I take that pre-tax income and I divide by the total tangible assets and make sure it's multiplied by 4 if we're looking at quarterly so that it appears as a yearly number. And you can see here they're making right south of 20% pre-tax return on tangible assets, which is pretty strong. Look, they have this big outlier. That's a good outlier, but it's still an outlier. Okay, so like I said, hovering around 20% is good. I'm not so sure that this one's that bad. I need to see a couple more, but the good news is you've kind of maintained, if not grown, your pre-tax return on tangible assets. And being above 15%, in my opinion, is really good because you got to think about it like this. If you had an investment account at all or owned a business, 15% pre-tax on your money is pretty good. Would you be happy owning an asset that you paid $100,000 for that made you $15,000 to $20,000 a year pre-tax? That's the question you got to ask yourself. And I think that that's pretty reasonable and that's a good return on tangible assets, especially with it growing. So I'm going to mark that green. Next up, we're going to look at our total equity. So this is all your assets minus all your liabilities. And what you're going to see here, where is it? Total equity. This is how Yahoo calls it. Total equity, gross minority interest, but it's total equity. And you can see here it's negative. So that's a little concerning because what do I always say? This is the net worth of the company. This is like, watching their bank account. And, even if a company's making money, you'd be a little concerned if their net worth isn't growing because you're like, where's the money going? Well, in this case, I'd be a little less concerned. And the reason has to do with what that article mentioned. If you remember, the article said something like they returned $20 billion of shareholder value in the form of dividends and buybacks. The dividends especially, if you're paying big dividends, I'm not expecting your equity to grow significantly because you got to think about it like this. This is watching the company's bank account. If they're paying dividends, that's just leaving the bank account going into your bank account, so it's gone. So tracking this isn't actually that great of a metric if you're dealing with a company that pays a lot of dividends. All right, that being said, they're still getting a red for this. One thing before we go to number of shares, I always like to look at, especially with a negative equity, is my assets to liabilities ratio. So this is going to tell me, how bad is this negative equity, right? Because you could have the same negative equity, but have a completely different debt structure, debt to asset structure, right? So for example, a company that has $1 million in debt and only $900,000 of assets, they'd have an equity, right? 900 minus $1 million. So they'd have an equity of negative $100,000. But if you had a company that had assets of $10,000 and liabilities of $110,000, you would likewise have $100,000 negative equity. But you would much rather own the one where your assets to liabilities are really close, right? 9 and $1 million, or 9 and 10 versus 10 and 100. You see, I don't know if you followed that, but anyway, the way to look at that is the assets to liabilities ratio. So in this case, it's really close to 1. I'm not concerned. It's between 0.9 and 1. The total equity isn't as big a deal now, especially with the dividends and the buybacks. Okay, they're spending a lot of money doing that. All right, let's go to number of shares. Let's see, ordinary share numbers. And this is awesome. So shares decreasing is almost always a good sign because, like I said, the company, if they're rational, should buy back shares if they think they're at a discount and they can't do anything better with the money. We already saw that they can make 15 to 20% on their money by reinvesting in themselves via the return on tangible assets. So this is great. Share repurchases is a plus almost always. Look, and it's not just a little bit either. You went from close to 1.8 to 1. Okay, let's go to our cash flow statement. Free cash flow is first, and like the income, you like to see it going up and positive and increasing, and it's positive and increasing. Look at this. This is awesome. So I'm just going to take an average of like this last, 1, 2, 3, 4, 5, 6. The average of the last 6 quarters. All right, and I get an average pre-tax, an average free cash flow of $1.5 billion per quarter times 4 is $6 billion of free cash flow per quarter. Awesome. And this is good. This is higher than their pre-tax income. That's a good sign. All right, real quick, let's look at depreciation and CapEx. I'm just looking for something that might stand out. Okay, $200 million a quarter in depreciation. That's how much their assets are losing value on paper. We're going to look at capital expenditures real quick, and less with a big one. This is nothing. It's also a super small percentage of their total free cash flow, right? This is 200 million that they're around. And so 200 million per quarter. So about 800 million a year divided by 6 billion. So that'd be 6,000. It's only like 13% of their total free cash flows having to be put into CapEx. I say only, at least it's, not 20, 30% or something crazy like that. But I've seen that in single digits, and that'd be even better. All right. Let's go to value. Oh no, I got to look at dividends. Let's just look at dividends real quick to confirm what that article said, and make sure, because if they're not paying significant dividends, I'm actually kind of worried about that equity. Yeah, they're paying a decent dividend. So let's see, about $250 million per quarter times 4 divided by 6,000. So about 17% of their free cash flow is going to dividends. Yeah, it's going to be hard to grow equity whenever you're always paying out 17% of your cash. Okay, so that gives them kind of a pass on the total equity. The way I'm going to mark that is I'm going to just marked dividends in green. All right, so let's go to valuation, get a number for ourselves, and see if they're undervalued. We got our 3 exercises that we're going to run through. The first one is the easiest, your pre-tax income that we estimate times 10 divided by your number of shares. And that's my target share price for that is $50 a share. That's good, that's higher. All right, next one is the formula from the Intelligent Investor. I've said this before. I don't really rely on this one too much in my own investing, but it's a formula that Ben Graham had in his book, so I keep it in there. So let's see, what was it? It's earnings per share, 372, times 8.5, plus 2 times our growth rate, which we said was 4, and $61 a share. I think that this formula tends to overvalue stocks. That's just my opinion, but like I said, it's from the Intelligent Investor. All right, and then lastly, we're going to do a discounted cash flow, DCF, and I got the formula here. You just sum all the free cash flows for every year, and then discount it back at the appropriate rate. Okay, so our free cash flow per year we said was $6 billion. Perpetual growth rate, I'm just going to cut their other growth rate in half, 2%. And discount rate is your opportunity cost. That's what else would you be getting with the money if you didn't invest here? That's what your discount rate is. I use 15%. I've been hovering between 13 and 15%, but I'm just going to be consistent and use 15%. All right, and I get a net present value for the market cap of $53 billion. Real quick, I do the net present value, I do the DCF out 100 years, but you can see, really, with such a harsh discount rate, you really stop counting after a little while. You can see how this graph just plateaus right at 53, even like starting at less than 20 years. All right, anyway, 53, I gotta get that to a share price. It's gonna be $50 a share again. That's crazy and that's just what I want to tell you again. I've mentioned this so many times. This pre-tax income times 10. Think about how much easier that is than this massive formula over here that projected out the cash flow of the company for 100 years, discounted it back, and you get the same exact value versus just multiplying by 10. That's why I love this thing, because I've said this before, the real work, I think, in investing, the real legwork is in the front end. All the, judging the health of the business, judging growth rate properly, seeing if they have a sustainable competitive advantage, a moat, if you will. The valuation's easy, and it should be easy, especially if it's undervalued. And it turns out it does look like it's undervalued, at least to me at first glance. Look at this, 54 divided by the current share price. It's showing probably 46% upside from this valuation. I can see why Berkshire bought it. I think it matches all the criteria we kind of talk about usually, besides maybe the equity. But like I said, they get a pass on the negative equity because of the heavy dividends. Do I own any? No. I'm pretty picky about the stocks I own, and I have to know the product or know the industry pretty well, and this is not one I feel comfortable. I don't know the last time I even saw an HP. But that's just my personal opinion, all right? I'm sure if you have an edge here, if you know the company better, if you feel like it's heading in a good direction, this is definitely a good price point in my opinion. But that's, like I said, I don't own any, and this is not advice. But anyway, I hope you learned something. I hope you check out more videos, and I'll see you next time.